Hello friends, how are you doing today? I hope watching these videos has enabled you to navigate through the market's static and the market's volatility far better. I would begin this video by thanking you for making our last weekend's weekly market outlook video by and far the most popular video so far in terms of number of views since the time I started putting out these videos approximately 6 months ago. I derive a lot of satisfaction when I meet intelligent, intellectual, thoughtful, and very careful investors/traders, and we communicate together, join me on social media, have conversations going, make each other better traders out there. That is the motto of this channel, to connect with intellectual traders and investors. And in that process, we will continue our efforts to bring you more and more cutting edge stuff out there. So the markets did finally correct the way we thought they would because of the factors that we said would. Now these factors have only become much more in the limelight and much discussed, like bond yields, inflation, the US dollar, etc. But like I said, as thoughtful traders, we are aiming to be slightly ahead of the curve, and through these videos, I want you to think ahead of all the other contemporaries and your competitors out there. So the decline and the cause of the decline was along expected lines, and here again the bank Nifty suffered a relatively bigger loss compared to the Nifty 50 because it is more sensitive to the US dollar, the inflation metrics, and the volatility in the bond prices. As you can see on the market roundup window on your screen, the overall retail skepticism was, in my opinion, higher from what I got from interaction on social media and talking to a lot of people. Compared to January, when people were really gung-ho and extremely bullish, there seems to be a certain amount of skepticism that has crept into the sentiments and which is now reflecting on your screen. So what you saw is the US dollar rising. You saw industrial metals retreating because the dollar was firm. And you also saw oil prices, although on a week-on-week basis, they've closed marginally lower, but there's been a sharp pullback ever since a very large cargo ship ran aground in the Suez Canal. You know, the irony of the situation is that the Suez Canal is not responsible for more than 6% of the global flow of crude oil. So the markets have seen a short covering in crude, and crude, like I have told you in my previous videos, is what I call a multiplier commodity. Rising crude oil prices result in everything from your taxi and auto rickshaw fares to your food, your fruits, your vegetables, grains, pulses, everything to go up, and inflation causes nothing but misery, which is what the market understood and therefore brought prices down. Now, natural gas rose on a week-on-week basis, and that again was something that weighed on the markets in tandem with the firm US dollar. Now, what we have seen from the US dollar is that not only did the Dixie, which is the US dollar index as a global benchmark against all global currencies, but the USD INR, which is the US dollar versus the Indian rupee, both rallied. So far, the USD INR tended to be weak compared to the Dixie, which means the rupee was relatively stronger. But now, what we have seen is that the rupee has weakened, although not as much as the Dixie has risen, but definitely that disconnect is now seemingly closing. The saving grace for banking stocks was the falling bond yields as the RBI finally had its way. Now, coming up on your screen is the MWPL chart, which tells you that after a steep but very routine fall on expiry, the market-wide open interest has now started rising again. This is along expected lines. History has taught us that This is a routine phenomena and there's nothing else to it. Now check out the basis chart. Basis is the premium of futures over the spot, and it indicates optimism or lack of it thereof. Now the basis shows a huge jump on a week-on-week basis, and this is again not really very surprising. This is the beginning of a new derivative cycle, the April series, and since traders have the entire 4 weeks to play around with, they are willing to pay a big premium to trade in the futures as compared to spot. As and when the derivatives series kind of progresses, this basis is expected to come down. This is also a routine matter. So now what you are seeing on your screen is that the volumes of the Nifty and the Bank Nifty together as an index. These are cumulative volumes across April, May and June futures, and stock futures, again May, June and stock futures, basically tell you that volumes have fallen sharply on Friday. And unfortunately for the markets, Friday was a bullish day, but volumes have really collapsed. So volumes were rising on falling days and the volumes actually collapsed on a rising day. So bearish days were seeing higher participation, bullish day lower participation. Now I'm willing to give a benefit of the doubt to the bulls here, partly because Monday being a holiday, I can understand instead of 2 days of a weekend holiday, this time around there are 3 days of a holiday, but still the volumes could have definitely been higher. Now, another factor that the market seems to ignore is the fact that the basis being 100 points plus higher, it also means that the decline that you saw in the market roundup on the Nifty and the Bank Nifty is not really the true picture. For a bull, the mark-to-market loss is bigger because he has paid cost of carry or rollover cost. Now, this is definitely, in the real trader's point of view, an expense which must be accounted for. Now, take a look at the chart coming on your screen. This is the impetus chart which I introduced a couple of weeks ago. Now, do remember that this is an impetus chart with a 20-day look-back period, and the momentum seems to be falling and the current trend being downwards. Therefore, I would infer that the declines are losing steam. But before you jump the gun and begin bargain buying, I would caution you that the confirmation of an up move must come from the price and not just from the impetus oscillator. So both must rise together before you venture out to buy. The roundup done, let's now go to the 10-year benchmark bond yield, which has fallen from its recent high and eased considerably as the Reserve Bank of India prevailed over the bond traders and the RBI had its way. Now, some amount of flight to safety is also seen in the markets because equity markets were weak and therefore some bond buying may have also occurred. The test will, however, come from April onwards because the RBI will now in April begin mopping up the targeted rupees 12 lakh crores on behalf of the Government of India from the bond market. Do also note that the week gone by was a very interesting one as far as bond traders are concerned. There was turbulence as the Vice President of Argentina declared that Argentina may actually miss repayments of $45 billion worth of sovereign bonds. Now that is a really worrying development in the bond markets. And the other was Brazil, a country much bigger than India and Argentina, of course, saw the bond traders were asking for higher rates in spite of the fact that the Central Bank of Brazil recently raised rates. Now this is basically a worrying sign again, and if this is to actually spread across the emerging markets universe, the fallout which I believe is something that I even tweeted about and posted on my other social media pages, is that the fallout of the global stimulus to fight the corona pandemic, the fallout would be either higher taxes on the citizens and or rising rates. Now that could be a double whammy. And if you've been following my videos for the past 25 weeks, this is the 26th week in a row, you would have realized what a seriousness you should assign to bond yield. So keep watching this space very carefully and stay tuned. This is something that I post even on my social media accounts every day, so do connect with me there if you feel like and get these updates late in the day. Let's now go to the US dollar index, and this US currency benchmark, which is the US dollar versus a global basket of currency, is blazing a trail, as I have been warning you since the last few weeks. Observe the daily chart on your screen. The rally in the US dollar index has sent oil and gas prices higher in India. Because we are an import-dependent nation, this is something that I have been rubbing into your subconscious mind since many, many weeks. And anything that is imported will become more expensive if the dollar was to become stronger. And crude oil, unfortunately, is a multiplier commodity. It triggers inflation from auto and taxi fares to food, grains, etc., which is what you are seeing in the Indian markets. Now, this is a critical aspect that I feel has been missed by the broader section of the markets, which I want to bring to your notice. And note on the daily chart how the 92.60 hurdle, which I have been talking about in my recent videos, has been finally overcome. And the price is above its 25-day exponential moving average, which itself is rising. The lows or the bottoms are edging higher because safe haven buying is emerging in the US dollar, and all emerging markets, including India, need a weak dollar. But the current trend seems to be far from weak, which means this is a problem for emerging markets as a pack or as a category. Now check out the weekly chart of the Dixie, and the price is comfortably above the 25-week exponential moving average and the 91.50 level, which I talked about in the last couple of weeks, has now become a floor support. It's possible that further rallies may be interrupted by corrections, but in that case, as long as the 91.50 level holds, the bulls in the Dixie are still in charge. Now, last week I advocated a range between 93.05 on the upside and 90.80 on the downside, which held perfectly well. Next week, I expect an estimated, I repeat the word estimated, range between 93.90 on the upside and 91.60 on the downside. Friends, now the dollar index done. Let's proceed to the Bank Nifty, which underperformed the Nifty 50 on a relative comparative basis. And this is something that I had advocated even last week. Do note that the Nifty is, relatively speaking, broader based, comprising of 50 stocks. And on the daily chart on your screen, note how the index is trading well below its 25-day exponential moving average. And the internal or the steeper blue trend line, which kind of hints that this breakdown from this trend line may be confirming a bump and run reversal pattern on the daily chart. Now that could be a sign of some concern for the bulls. The rally on Friday was on very poor volumes, and the impetus chart which I showed you was telling you that the momentum was easing, the downside momentum was easing. So basically, these are collectively speaking uncertain indications. On one hand, the downward momentum is easing. On the other hand, the rally is not garnering enough volumes, which means there is a conflict of opinion. So since the outlook is slightly cloudy, We'll allow the price to tell us in the coming week where it is headed. Like I pointed out before, March ending is a very unique period because volatility tends to go high because retail traders are busy cleaning up their books of accounts and mutual fund resorts to what I call NAV propping or boosting the prices so as to declare a higher NAV. So Thursday's low in the spot at 32,415 level is a level that I would want the bulls to defend if they are to put up any fight in the coming week. On the flip side, only a closing above the 34,500 level sustainably will trigger a very short-term buy decision by traders. I'm talking of traders, not investors. Now let's check out the weekly chart on your screen. The price remains above the 25-week exponential moving average, which means that the longer-term upthrust is still remaining intact, but for now. I would therefore call this fall a technical correction as yet. I would not want to call it a bear market beginning or a bubble bursting, which would be a premature thing to say. Now, the high of the week prior to last, which is the week ended on 19th of March 2021, was 35,544. Now, this is a hurdle that must be overcome on a sustained closing basis before delivery investors, now I'm talking of delivery, before delivery-based investors can start buying again. Now, in the week before last, the index was at number 2 on the most volatile list, but last week it fell to number 3. Not because the beta or absolute price volatility of the Bank Nifty fell, but because the beta of individual stocks rose. Now, last week I estimated a range between 36,050 on the upside and 32,250 on the downside, which held perfectly well in spite of all that volatility that you saw in the market last week. Now, in the coming week, you're likely to see an estimated, I repeat the word estimated, range between 35,225 on the upside and 31,425 on the downside. I would advocate that my friends stay light and trade with strict stop losses because the markets are kind of edgy and nervous out there. So protect your capital by trading light. Friends, the Bank Nifty done. Let us now go to the Nifty, which is the most liquid and low impact cost traded instrument on the NSE derivatives segment. And this counter is a better yardstick or a better measure to gauge market sentiments because of its composition of 50 stocks. Now, the Nifty 50 fell far lesser than the Bank Nifty. And if you look at the daily chart, you will see that the price is definitely below its 25-day exponential moving average. But it is not as far below as the price was in the case of the Bank Nifty, below the same average. The semi-log scale chart shows the bullish trend line is violated convincingly for the first time since the time this trend line was plotted. Now, that raises some signs of concern, and like I said, in the case of Bank Nifty, this does indicate a technical correction which is underway. The previous swing low, which was made on 26th of February, was violated, but on an intraday basis because Friday's closing was above that. Now, this swing low of 26th Feb at 14,467 in the spot needs watching. If the bulls allow this index to fall below this sustainably, further downsides can open up. So you need to monitor this aspect very keenly. Traders on the flip side should consider buying in the short term. I'm talking of trading buys, not delivery buys. Only above the minor swing high of 14,879, which was made on 23rd of March 2021. And that too on a sustained closing basis. Let's now revert to the weekly chart, which shows the price is above its 25-week exponential moving average, which means the longer term trend still remains upwards as of now. Things can change. Now, no fresh delivery based buying should be considered unless the 15,432 peak made in the week ended 16th of February 2021, or on 16th of February 2021 rather, is overcome on a sustained closing basis. As far as I'm concerned, I would prefer to lie low and trade on very thin exposure so that I can avoid the high beta or pure price volatility that a holiday shortened week is likely to witness. In the week before last, Nifty was at number 8 in the most volatile counters list. Last week also it maintained the same position. And last week I advocated a range between 15,325 on the upside and 14,175 on the downside, which held perfectly well in spite of all the volatility and the ups and downs in the market. And the coming week is likely to see an estimated, I repeat the word estimated, range between 15,100 on the upside and 13,925 on the downside. Now the risk reward ratio remains hostile for fresh, big ticket, aggressive leverage buying. So stick to small positions, don't get aggressive, don't leverage, and you should basically enforce your stop losses without fail. In short, trade light. Friends, the Nifty done. Let's now proceed to the most popular segment of this video, wherein I recommend 5 stocks of high beta, high impetus, wherein you take small exposure, wait for large price moves, and 5 stocks which are low beta, low impetus, where you take large exposure and trade for small price moves. Now the high beta list is led by Mahindra & Mahindra at number 1, Indigo at number 2, Bharti Airtel number 3, Pidilite Industries number 4, Adani Enterprises number 5, and the low beta, low impetus stocks list is led by Mindtree at number 1, ICICI Pru Life at number 2, Alchem at number 3, Coforge at number 4, and NAM India at number 5. Now friends, this hierarchy can change anytime because intraday volatility changes from day to day, and therefore the order of preference, the ranking of these stocks can actually move on a day-on-day basis. Friends, if you liked what you saw in this video, please subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive fresh alerts on any content being put up out here. In the comment section, do keep the lines of communication open. I'd love to hear from you. And coming up on your screen are my contact coordinates. I would love it if you connect with me on social media like you have in the last 2 or 3 weeks, connected in larger numbers. I love communicating with you and sharing my ideas online. And I hope the coming week is a very, very profitable one for you. Take care of your trades and investments. Thank you for being with me and watching my video. Bye-bye.